What's going on, everyone? My name is John with Mortar, and I'm an economist. Today we're talking business ownership once again. In the last video, we talked about why business ownership can change your financial ceiling, but there's a major question we deliberately left open. How do you actually become an owner? Because starting a company from zero is only one answer. You can build a business, you can buy one that somebody else built, or you can open your brokerage account and buy ownership in publicly traded businesses. All three can make you a business owner. However, they don't give you the same job, the same control, the same liquidity, or the same level of risk. Starting might require relatively little capital up front, but consume thousands of hours of your life. Buying might give you customers and cash flow on day one, but might require much more capital and serious due diligence. And buying stock can make you an owner in seconds, but that doesn't mean the CEO is calling you tomorrow morning asking how to run the company. So the useful question isn't which path is best. The better question is what kind of owner are you actually equipped to be? And we're going to answer that question using 6 things: capital, time, control, concentration, liquidity, and evidence. If you want to keep building the owner's framework one layer at a time, subscribe to Valiant Mortar. Let's start with what these 3 paths have in common though. Owning a business doesn't necessarily mean you founded it. It doesn't automatically mean you work inside it, and it definitely doesn't mean every owner has the same level of control. At the simplest level, ownership gives you an economic interest in the enterprise. With a private business you control, that can include making major operating decisions, hiring people, changing prices, deciding where to reinvest, and eventually deciding whether to sell, subject to whatever partners, lenders, contracts, laws, and obligations apply. With publicly traded stock, the shares represent equity ownership too, but unless you own an unusually large stake or have some special governance position, you generally aren't operating the company. Management runs it. Your job is different. You're evaluating the business and deciding whether you want your capital invested in it. There's an important distinction between being your own boss and owning productive assets. Those two aren't exactly the same goal. There's a 2 Chainz line from his 2019 song Threat to Society that gets right to the ownership principle. It goes, "Master of my own fate, I own my own masters." In music, masters involve rights connected to song and album recordings. So I'm not saying that's identical to owning a restaurant or common stock. The useful principle is simpler. What you own and what rights come with that ownership matters. That's exactly what separates these 3 paths. Starting a business means you're creating the economic engine instead of paying somebody else for an engine that already exists. You identify a customer, you find a problem worth solving, you develop an offer, you determine what it costs to deliver, and then reality gets a vote. Will anybody actually pay you? That's both the advantage and the risk of starting. You're not paying a previous owner for years of established customers, employees, systems, equipment, or operating history, but you're also not receiving those things. You're beginning with uncertainty. Maybe you know landscaping extremely well and you see an underserved neighborhood. Maybe you've worked 10 years in an industry and understand a customer problem that somehow nobody else handles efficiently yet. Maybe you've developed a specialized skill that can become a service business. Your advantage is that you can design the company around the opportunity that you see. Your disadvantage is also that the market hasn't proven you right yet. And this is where people sometimes underestimate the real startup investment. It isn't only money, it's time. If you spend 18 months building a business that pays you almost nothing, those 18 months had an economic cost. You could have been somewhere else earning a steady paycheck, or you could have been developing another skill or investing that capital somewhere else. That's opportunity cost. So the startup route can be especially attractive when your strongest asset isn't necessarily your checkbook. Maybe it's expertise, or customer insight, or sales ability, or even technical knowledge, or maybe some operating advantage that lets you create an asset for less than it might be eventually worth. But don't confuse low startup cost with low risk. If your household needs money and you put that into an unproven company, business risk has now become personal financial risk. And that's exactly why our emergency fund and cash management video came before this ownership series. Your financial foundation and your entrepreneurial capital shouldn't casually become the same pile of money. The second route, though, it flips the equation. Instead of asking, how do I create a functioning business? You're asking, can I acquire one that's already functioning? That can mean existing customers, existing employees, existing equipment, existing supplier relationships, existing revenue, existing expenses, and hopefully enough financial history to understand whether the economics are actually attractive. But there's another word we need to add: existing problems, because you don't acquire only the good parts. A business can come with customer concentration, old equipment, weak accounting, high employee turnover, debt, bad contracts, legal exposure, a damaged reputation, or an owner whose personal relationships are more important to the revenue than you realized. That's why acquisition is fundamentally a due diligence game. You're not buying what the seller says the company could become. You're trying to understand what you're actually acquiring. Why is the owner selling? How dependent is the business on that owner? How durable are the customers? What obligations come with all of this? And will the economics transfer after the ownership changes? And this is where the McDonald's movie, The Founder, becomes useful. The movie dramatizes Ray Kroc's encounter with the McDonald brothers and the operating system they had developed. What's interesting for this discussion isn't really the burgers. It's the distinction between creating a system, operating a system, expanding a system, and controlling the economic rights surrounding that system. Historically, McDonald's says Dick and Mac McDonald had redesigned their restaurant around the SpeedX service system in 1948, years before Kroc encountered the operation in 1954. Don't treat the Hollywood movie as a replacement for the historical record, but as an ownership reference, it gives us a very useful lens. A functioning business is more than an idea. The value can live in systems, customer habits, employees, locations, contracts, processes, intellectual property, and the economic rights attached to all of those things. When you buy a business, that's what you're trying to evaluate, not whether you like the idea, whether the economic machine is worth the price, and whether it'll still work when the previous owner is gone. The third route is the one Valiant Mortar viewers probably know best. You can buy shares of publicly traded businesses. And I want to be precise here. A stock isn't merely a ticker moving around on your phone. It represents equity ownership in a corporation. Investor.gov describes a share of stock as an ownership position in a corporation. That doesn't mean buying 10 shares gives you meaningful operating control, though. It means you participate economically as an owner according to the rights attached to those shares. This route changes the ownership equation dramatically. You don't need enough capital to buy an entire company. You don't need to hire employees, navigate a lease, collect from customers, manage inventory, or personally answer the phone when something breaks on Saturday morning. And public markets make it far easier to spread your capital across multiple businesses than if most of your money is tied up in one privately held company. But you're giving something up for that convenience, and that is control. If management makes a bad acquisition, you generally can't walk into headquarters Monday morning to cancel it. If management changes strategy, an ordinary investor doesn't suddenly become the operator. Your most practical control is over your own capital allocation. You can buy, you can hold, you can sell, and you can pass on that opportunity. You can decide what price makes sense to you. That's why each ownership route ultimately demands a different skill set. The founder asks, can I create this business? The acquirer asks, can I buy and operate this business at an attractive price? And the public market investor asks, is this business good enough and is the ownership interest attractive enough that I want to allocate my capital to it? Those questions overlap, but they aren't the same question. So let's bring all three paths together. I wouldn't decide based on which one sounds the most entrepreneurial. I'd run an ownership fit test. Start with your capital. Ask yourself, how much capital can I commit without damaging my financial foundation? Starting can sometimes be tested relatively cheaply. Acquiring an established company may require substantial purchase capital or financing. Public stock ownership can begin with comparatively small amounts, but dollars are only one resource. Public stock ownership can begin with comparatively small amounts, but dollars are only one resource. Now ask, how much of my time do I want this ownership to consume? A startup may demand almost constant attention. An acquired business can still require active operation, especially during the transition. A public equity portfolio can require research and monitoring without making you responsible for the company's daily operations. Then think about control and concentration together. How much control do I actually want? If you have a strong operating vision and want to make the decisions, private ownership may fit that objective better. If you'd rather allocate capital to businesses and managers you respect, public market ownership may fit the role you're actually looking for, but greater control can come with greater concentration. A private business can become a huge percentage of someone's income and net worth. That can create substantial upside if the business succeeds, but it also creates vulnerability when things go wrong. Public markets make diversification much easier. Then there's liquidity. How important is the ability to change my mind? As I've mentioned in previous videos, a publicly traded stock can generally be sold quickly during normal market conditions. A private business, though, might take months to sell. You might not even find a buyer for it. And the price somebody's willing to pay may be very different from the value you have in your head. Liquidity gives you flexibility. Illiquidity can encourage long-term thinking, but it can also trap capital right when you need it. Finally, just ask yourself, how much evidence do I have before I put capital at risk? A startup usually begins with the least operating history. An existing private business may give you years of records to investigate, which is one reason the SBA, or Small Business Administration, emphasizes reviewing the existing operation and performing due diligence before buying. A public company may give you audited financial statements, regulatory filings, earnings history, and extensive industry information. More information doesn't remove uncertainty. It changes the type of uncertainty that you're dealing with. And here's something I don't want you to miss. You don't have to choose one identity for the rest of your life. You could invest in public businesses while developing the expertise to start your own. You could build a company, eventually sell it, and diversify some of that capital. You could become a strong operator first and use those skills to acquire another business later. These aren't three teams you're required to join forever. They're three capital allocation paths, and different stages of life can favor different combinations. The objective isn't to collect the title entrepreneur. It's to understand your resources, your advantages, your responsibilities, and exactly what kind of ownership you're buying or building. The last video made the case for ownership. This one gives you three routes for how to go about it. You can create the asset, you can acquire an existing asset, or you can buy equity interests in businesses through the public markets. Each path gives you a different combination of capital requirements, workload, control, concentration, liquidity, and evidence. So here's the practical next step for you. Take a piece of paper and write down 6 words: capital, time, control, concentration, liquidity, and evidence. Now score each ownership path based on where you actually are today. Not where you wish you were at, where you are. And whichever route interests you most, the next question eventually becomes the same. How do you tell whether the underlying business is actually financially healthy? Well, that's where we're going next. Revenue, profit, cash flow, and debt. If you want to keep building that framework from personal finance into business ownership and long-term investing, subscribe to Valiant Mortar. It really helps out the channel. And comment below with the path that interests you most right now: starting a business, buying one, or investing in public companies. This has been John with Valiant Mortar, signing off.